Yeah.
Order filled, check us out.
You know what time it is.
This is a Mighty Soldiers exclusive.
Yeah. Let's get it. Let's get it.
How you guys doing? I'm Andy with Mighty Soldiers Trades. Tonight we have an amazing event for you. Carley's joined us tonight, and we want basically. I'm just going to bring her right on. I'm not even going to wait. And hi, how you doing tonight, Carley?
Hi, Andy. It's good to be here. Thank you.
This morning, I'm just going to start the day. We got up extra early and we went down to the beach. I told you a little bit about this, and I just went straight to the beach, and we ended up seeing this crowd of people, and they had these two giant sea turtles that they released, and then a baby sea turtle. So that was amazing. And, finally got to round it back out to go into the zoo, but was in the sun all day. So super, super tired.
Well, hopefully I don't bore you and put you to sleep. So that'll be my goal.
Oh, absolutely. Never. So I was reading your books. I love your books, by the way. And one of the things new traders want to blame their brokers, and the glitching of the brokers. If the charts freeze, the broker's doing that on purpose. I had a broker where my P&L would go awry. It would go crazy. Mm-hmm. So I'd be losing maybe $100, but it's telling me I'm making $2,600, and I don't know what's going on. So I'm like, here, let's close this. And I close it, and I end up having a loss when I do the numbers. I should know better, but as a new trader, I didn't. I was just trading off the P&L. And then, all these different things with data. When we had the big market crash, data, started glitching all over the place. I saw even my web-based platforms, the data wasn't working right,
Right.
So new traders see this stuff happening. I'd say it's mostly new traders, and they think that, the broker's out to get me. And I know that you have a lot to say about that. So.
Sure. Okay. So there's a lot of facets to this conversation. So for starters, brokers only make money if their clients are trading and are happy. If clients are upset or clients aren't having a good time, they stop trading. That's not what brokerages want you to do. They want you to trade. They make money on commission. So I can't imagine in any scenario a broker would intentionally cause some sort of technical issue to prevent their clients from trading and generating revenue. Also, when you are trading on a trading platform, the data that comes through and the technology that you're using isn't something that just pops out of thin air. There are a lot of people on the food chain that are creating that data or that information or that technology and distributing it to you so that you can see it. And things can go wrong. Unfortunately, technology is very, very complicated. Anybody that's ever tried to build a website using HTML or even nowadays they have websites you can build with much easier interfaces, but they're still extremely complicated. And it's the same with trading software. There's just so many things can go wrong. It might be something in the data that throws off the platform. It might be a power outage in the middle of, who knows, Illinois or Iowa where someone's server is that causes trouble. So literally so many things can go wrong. And the interesting thing is since the COVID shutdowns, more things have been going wrong for brokerages than we've ever seen before. And it's because of shortage of staff, shortage of programmers to fix things when they go wrong. And so all of the things that you experience when you go to a restaurant, the lack of service and the lack of manpower to run the restaurant is going on in brokerage firms as well. So please understand that there's just a lot of things going on. But the reality is brokers want their clients to trade. They want their clients to make money because the more money they make, the more they trade, the more the brokerage makes. So everybody's trying to win. It's supposed to, in theory, a perfect relationship would be win-win on both sides. Another thing I should point out also is I just mentioned being a broker. I'm a broker myself. For full disclosure, I make money on commission. We only make money if let's put it this way. You get what you pay for. So a lot of people are really worried about getting the absolute cheapest commission, and I totally understand why. If you're trading, especially if you're an active trader, the more transactions you make, the more commissions you pay, and then it starts to add up at the end of the month or year or whatever period you're looking at. It can be quite expensive to pay brokerage fees. So I totally understand that. But the reality is, if you're if you go to a broker just because they're the cheapest, you're probably going to get exactly what you're paying for, and that is probably subpar technology, zero support. Good luck if you try to call your broker or send them an email. Nobody's going to respond or answer the phone. And if you do get somebody, it's probably going to be a clerk that has literally no idea what you're talking about. So it's really hard to get service. The only way to make sure that you'll be taken care of when something goes awry is to confirm that you're with a brokerage that is charging at least enough in commission to operate on a proper scale. And not all of them do that. Some of them charge so little in commission they literally can't afford to answer the phone. So
Yeah.
the third point I'm going to make, and then we can you can jump in. The reality is, if you think you're paying too much in commission, you're probably trading too much. And to be honest, the more you trade, the more likely you are to lose money. The less you trade, the more likely you are to make money. So trading is often less is more game. And if you're paying a ton of commission, it's probably simply because you're hitting the buy and sell button way too much. If you just laid back and disciplined yourself, not only would your trading probably do better, but you'd probably pay a lot less in commission.
I've actually had my broker reach out to me and tell me that I trade too much. And
Well, you have a
that
great
was
broker then. Good.
that was the last thing that I wanted to hear. They didn't say I trade too much. They said you're putting through too many orders, and I was just like, how dare they? That's how I do what I'm doing. Leave me alone, you know. And
Right.
I didn't understand that brings us around where there's dangers that brokers face from the traders. We always think that the broker's out to get us. The broker is
Right.
trying to mess us up, you know. And I'm just speaking for things that I've heard
Sure.
from traders, you know, not everybody obviously, but you know, we want to blame somebody else. I that's the opposite of who I am as a person. I love that there is an explanation, and there always is an explanation as to how clearing takes place. I don't even think most traders knew before the whole GameStop thing and all that. A customer can actually hurt their own trading and bring additional risk to the broker by the way that they're trading, right?
Correct. Now, what you're referring to is mostly on the stock side of things. I deal with futures and options on futures, which are different in that if you're buying and selling stock, you're basically depending on which brokerage firm you're using and what's going on. But a lot of the times you're actually buying and selling stock out of the brokerage's own book. Like it's not going to an exchange to be executed. It's just being executed out of the book. Sometimes it is going to the exchange and there's a third party involved. So there's all kinds of things going on the stock side. On the futures side, if you hit the buy or sell button, it goes directly to the exchange. The broker itself has nothing to do with the transaction other than you're using the brokerage's technology to get that order to the exchange. Other than that, it's between you, your mouse, and the exchange. And once it gets on the exchange, the interesting thing about futures is unlike stocks, which there are sometimes middlemen and some bigger orders sometimes get preferential treatment, that sort of thing. In futures, it all goes to the same place. So whether you're trading with broker A, B, C, or D, your order is going to go exactly at the same speed. Maybe I shouldn't say that. Some brokers might be of a slight smidgen, tenth of a second faster, but in reality, is that going to help you or hurt you? My personal opinion is it's irrelevant because sometimes being that much quicker might actually give you a worse fill. Sometimes it gives you a better fill. So I think it probably washes out. So the way that we look at things, it's inconsequential. That said, you're treated the same whether you're trading a one lot or 50 lots or 100 lots. It goes to the exchange. It's all executed systematically without anyone being involved. So it's a lot different than stocks. But I can also say again, you mentioned that clients are risk to the brokerage. I can't really speak to the stock side of things, but I can say that, well, I'll just start with the GameStop situation and then I'll go into futures. But with the GameStop fiasco and the meme stocks, about a year ago, a year and a half ago, everybody was very upset at their brokerages. I'm not going to name any names, but the thought was now that the little guy is starting to make some money and hurt the big guy, then brokerages are shutting it down because that's not how they want the world to work. And that couldn't be further from the truth from my standpoint. When clients are trading especially in an online environment, they're buying and selling from their cell phones, from their computers. There's always risk to the brokerage. Now, if you're just buying and selling stock or buying options and you think that you're not trading on leverage, you're not, you're correct. But somebody on the other side of that transaction probably is trading on leverage. In fact, they are. If you're buying an option in GameStop, somebody is selling that option to you. So there is leverage on one side of the transaction. So somebody's facing unlimited risk, and that unlimited risk can come back and haunt the brokerage firm. If too many transactions are going through, the volatility is too high, the brokers just simply can't capitalize the transactions. And if something goes wrong and someone loses more money than they can afford to lose, let's say the market maker that sold those options gets into big trouble and they just simply can't pay for their losses, that's on the brokerage, and it can easily put a brokerage out of business overnight. It's not that hard to imagine that happening. In fact, from what I heard, that almost happened to a couple firms last year during the GameStop fiasco. So it wasn't the big guy trying to squash the little guy. In fact, it was the big guy just trying to survive so that he can be there to service the little guy. That's really what it was. On the future side of things, we have the same general risks. Anytime that we bring in a client, we are taking in risk. So a lot of clients, when they apply to open an account, they wonder why there's so many questions. Well, first of all, the government requires us to confirm that they are financially stable enough to trade futures because it is leveraged and it is risky. So not everybody should be involved in that type of speculation. But also we want to make sure it's kind of like applying for a credit card. So the brokerage wants to make sure if something goes horribly wrong and that trader loses more than he has in his account, will he be able to pay us back what he owes us? And the answer to that, in theory, if we're going to accept a client, should be yes. And if we don't, if we think the answer is no, our compliance department will say, you know what, it's probably not a good idea for the client or for us. It's just too much risk for both parties. And I can tell you, you're probably thinking, like, that's never going to happen. People can liquidate, or, you know, sometimes markets move really fast, and sometimes they move faster than anyone could have possibly imagined. I personally, as a broker, I've been on the hook for debits throughout my career, some of them well into the six figures. So it can happen, and it does happen, and it's not pleasant for anybody.
So basically, the things that clients can get their broker into trouble with, what comes to mind for me is maybe some unlimited risk type situations where they're not even understanding the risk at all. Maybe they're selling options, a bunch of them. I don't know. Like, what sort of things could get the client in trouble?
Sure.
Where it can affect the broker, where it would really be that crazy wild, like maybe the broker won't even let it happen, you know?
Right. So as a broker, I can tell you, we do everything in our power to prevent an account from losing more than they have on deposit. And that's because literally nobody wins. If you lose more than you have in your account, then it becomes a really big compliance issue, then legal issue if you don't pay. And I mean, it's really ugly. And for me, it can be very expensive. So we do everything that we can to prevent that from happening. But situations in which it can occur, people are going to assume, oh, well, they were probably selling naked options and they deserve it. Well, the reality is, it does happen with option sellers, but it can just as easily happen with futures traders, because imagine, like, for example, in March 2020 and April 2020 crude oil, or even if you want to talk about March 2022 crude oil, where we were seeing some really big gaps over the weekend. So for example, this year, I can't remember the exact date, but in March, I think it was March 3rd or something like that, the market closed on Friday at a certain price. And when it opened back up on Sunday night, futures trade around the clock from Sunday night to Friday afternoon, by the way, when it opened back up, crude oil was already up $14. So somebody that had, let's say they were short one crude oil future on the close on Friday, and they weren't even on a margin call, they had plenty of margin based on the exchange's minimum. Had they looked at their account on Sunday night, there's a pretty good chance, unless they had more than, let's say, $14,000 or $15,000 in the account, pretty good chance that from Friday's close to Sunday's open, their account not only lost what was on deposit, but more than. So those types of things, I'm not saying it happens every day. In fact, this last couple of years have been kind of weird. We've seen basically two black swan events that are super unusual, or at least they were before. Maybe this is our new normal. I really hope not, but maybe it is. But those things can happen. So big gaps up over the weekend can sneak up on futures traders. During the week, futures traders are a little less likely to lose more than they have on deposit, because most brokerage platforms now have auto liquidation settings that will basically just shut an account down and liquidate everything if it gets to a certain level, close to zero. So that's nice. But one thing that most people don't understand is That auto liquidation that a lot of futures brokers have does not work if somebody's trading options versus futures. So if you're long a futures contract and you also sold a call against it, or maybe you sold a put in addition, whatever the case is, if the market dropped sharply against you, the auto lick's not going to work because the bid ask spread on the option can throw everything out of whack. And the system knows that. And so they're not going to liquidate an account erroneously because the bid ask spread ballooned or something like that on a temporary spike. So that's one thing that can get people into trouble. And the other thing is just selling options without understanding the full risk. I am not against option selling. In fact, our brokerage caters to that sort of trading, but we also are very adamant about explaining the risks and making sure people know how to hedge if something goes wrong. And generally, we're not the type that generally just says sell naked options blindly. Instead, we're usually using option spreads that do have naked legs. So there's a little bit of a difference. But short options can, on occasion, really come back to haunt you when the volatility spikes. And if you're a little over leveraged, obviously that can get you into trouble. So those are the two primary situations where people can lose more than they have in their account.
And so on the stock side, if you're shorting, like a penny stock, that can be an obscene situation. That's not going to happen in futures.
So when you short stock, you are basically trading on leverage. You're borrowing shares to go short and then buy it back later. In futures, that's built into the exchange's mechanism. So you can go short a futures contract, whether it's corn or soybeans, crude oil, S&P futures, whatever it is. You can go short and then buy it back later. So it's really the same exact idea. So you're correct. If you sell it, you have unlimited risk on the upside and you're trading on leverage, you can lose more than you have in your account. In futures, though, it's a little different on the buy side because on the buy side, you're also using leverage. So for example, in crude oil, I'm going to kind of round here, but crude oil, let's just say crude's at $100 a barrel. That means one contract's worth $100,000. So if you go long crude oil from $100, and you only have, let's say, $30,000 in your account, you can withstand a drawdown of $30 in oil or $30,000 on the trade. But if it goes more than that, let's say it goes down to zero, which sounds crazy, but guess what? We were just there 2 years ago, which is totally wild. But let's say it goes from 100 to zero, that's $100,000. If you only had 30 in your trading account, you are losing 70,000 more than you put on deposit. Now, obviously, that's not going to happen in an instant. So you'd have plenty of time to get out most likely before anything like that happened, but I'm just using it as an example. You can go long and still have unlimited risk on the downside. Well, technically it's not unlimited, but it is, right? We saw crude oil in April of 2020. Not only did oil go negative, it went negative like 40 something dollars, which is wild to think about. And honestly, the press likes to talk about the negative oil situation that occurred a couple of years ago, but it really was kind of fake news because it was the front month that was going into expiration. There was only a few people trading it. Most brokerages like ours, we'd completely shut everyone off the platform. So you could trade other crude contracts, but you could not trade that particular contract. And so it's just unfortunate that probably a few green beginning traders didn't know what they were doing and either bought into it or sold into it, and nothing good happened. So.
On the stock side, I know that there was some ETFs that delisted, and I was holding some options in them because I was really excited. We have a lot of upside ahead of us, and it didn't work out the way that I thought. But I knew that there was like a lotto play. I managed my risk accordingly, so it wasn't much. I just heard a market maker recently. Their job is to provide liquidity and also manage risk. When I was reading your book, and you talked about the risks that brokers face. And then, I see that these market makers or these clearing firms, they're also managing their risk. And, going back to how traders are like blaming and everything, it's like a light bulb went off that, we could be getting in our own way. We could be causing our own problems without knowing it. And all we want to do is point the finger. It's better to figure out what's really going on. Maybe I'm sure there's a lot of people talk. You're willing to come on here and talk to me. And the reason I started doing these is because I never actually had a trading mentor. I just sort of picked from everywhere. I didn't even start with books. I just more started with the community. So the whole market making, clearing and stuff, how does that work again?
Sure.
With futures?
So I'm going to just comment real quick on something. You mentioned you were trading some ETF options when the crude oil blew up a couple of years ago. I would like to point out that one of the primary reasons crude blew up the way it did. Now, I'm not saying we couldn't crude wasn't going to 20, maybe even $15 a barrel. But the way the front month just completely collapsed the way that it did, most of that had to do with ETFs. So what ETFs do for in most commodities, not all, some ETFs are backed by the actual commodity. For example, GLD is gold, so that one's exempt. But some of the other stuff like the corn and wheat ETFs or the crude oil ETF, what they do is they take people's money and pool it and then go and buy futures contracts. Well, as people are buying and selling the ETFs, the managers have to go and buy and sell futures. It doesn't matter what price it is, it doesn't matter what else is going on in the universe. They have money coming in and out. And sometimes the commodity markets just don't have the liquidity to absorb all of those cash inflows and outflows. And it gets really, really messy. We saw it in oil twice, March 2020, and then again in March 2022. The ETFs just kind of really blew up the market and removed all reasonable price discovery. And then we saw it again in March 2022 in wheat. So I'm not a big fan of ETFs, to be quite honest, but we'll see. Hopefully things will improve as we go on.
So that's happening right now, recently with wheat, whole.
Yeah. So when Russia invaded Ukraine, all the headlines and the newspapers and on Twitter, everyone was talking about the food shortage and the fact that Ukraine is known as the breadbasket of the world. Like they produce a lot of corn and wheat, and that wheat and corn was not able to make it out of the country. Although we now know it's basically been slowly coming out, or a lot of it has, because Russia's been smuggling it. So it's a big, long, complicated story. But the headlines were, we're not going to get any Ukraine wheat. Wheat prices are, everybody needs to put their money in wheat. And that's exactly what happened. Everyone went and bought that ETF. And especially in today's world where, if you pull up a stock trading app, they have a heat map or what's the biggest volume, and people start seeing those ETFs, those commodity ETFs pop up on their list of most active or in their heat map, and they just start throwing money on it. They don't know what exactly, they probably have zero idea what exactly they're buying. They just know that they're buying wheat. They don't know it's futures contracts. They don't know which months. They don't know anything about it. It's just bandwagon trading. And so we saw wheat go from like $8 a bushel to $13 a bushel, back down to 8, and then back up. I mean, it's just been a really wild ride. A lot of that volatility would have happened anyway without the ETF, but the ETF really exacerbated it. And so, as a futures trader or somebody that's handling things on this side of the business, it's just kind of um, hard to accept the extra volatility that comes with just bandwagon trading of people that just don't fully understand what they're doing. So again, people are going to learn. I'm sure there were a lot of tough lessons learned over this situation, and I think it'll hopefully get better as we go, because these products are still relatively new.
If you don't mind me doing this, Carly, I
Mhm.
would like to back up. I normally do this earlier on in the conversation,
Okay.
but what got you into futures trading to begin with? How did you end up getting into this broker thing? How did this even unfold?
Well, I mean, it's really not an exciting story. So I just stumbled into it, is the reality. I went to college here in Las Vegas. I went to UNLV, and I originally was going to be an accountant, and then I realized accounting's not that fun. So I ended up getting 2 degrees, one in accounting, one in finance. With the finance degree, I thought I wanted to be a stockbroker or an investment advisor. And I did an internship, and I realized, what? That's really not that fun either. I was mostly just selling loaded mutual funds, and I'm not a salesman, and it just was kind of boring. And so it wasn't for me. And there happened to be one commodity shop here in town, and I just simply because I didn't know what else to do, I'm like, well, let's give it a shot. And it worked out, and I've been doing it ever since. So not an exciting beginning, but it worked out. It was meant to be.
Did you mess around with stocks first, or?
I mean, a little bit. I was more like I did some like investing with, but as a college kid, you don't have any money. So it was like buying a few shares of Home Depot, but so that sort of stuff, yes. But didn't really get into the stock thing. I went straight into futures, and like I said, it's just this business is really, really wild. It's tough. It's not easy. The highs are really high, the lows are really low, but I can't imagine doing anything else.
I just spoke with a pretty decent trader in our community. One of the things that he pointed out is he thinks that if you're not solid on your fundamentals, like really solid on your fundamentals, that you have no business trading at all. I've read that you have your own opinion on fundamentals versus technicals.
It's future stocks is a whole different animal than futures. Stocks are something that you can, if you're a trader or you think you're a trader and something goes wrong, you can probably just turn your bad trade into an investment, and if you hang on long enough, it's probably going to come back up. Futures don't work that way. Commodity futures, believe it or not, commodities actually spend more time going down than they go up. I know it's hard to believe, but if you look at a really long-term chart of commodities, let's say like the Goldman Sachs Commodity Index over the last 30 years, you'll notice we've had maybe 3, 4 really nice bull rallies, and then they always fizzle. The rest of the time, we're just dribbling lower, and there's a few reasons for that. Commodities are something that we produce annually for the most part, not all of them. But the reality is we get better at it all the time. So our farmers are getting better at growing. The technology's better. We have fracking. So all of these things make it easier and more efficient to get commodities to the market. So prices tend to have a downward slope to them as opposed to an upward slope like stocks. So fundamentals in commodities are a little bit different than fundamentals in stocks. It's just like apples and oranges. But with that said, in commodities, it's a strange animal. Usually when the fundamentals are the loudest is when the market's getting ready to turn. So for example, I'm going to talk about wheat again. In March of this year, when wheat, actually I take it back. I think it was June when wheat actually topped for the second time. Literally every time I turned on the TV, all I heard was, we're running out of wheat. People are going to starve. This is a disaster. And wheat was at $13 a bushel. And at the time, seemed almost impossible. Like anything else could happen other than wheat continue higher. And it turned around the next day and literally dropped $4 in a couple of weeks. So commodities, if you're trying to trade fundamentals, it's a tough game because the market front runs fundamentals dramatically, and there's really there's no pause in between. It just goes from feast to famine, boom to bust. So it's a little different game than stocks.
Well, as far as the wheat, I believe you had said that information from the government, people believe that that's gospel truth, and it couldn't be further from the truth.
As far as the USDA reports, yeah. So the government puts out estimates on what they believe supply demand is, what they believe the upcoming crops are going to be. For example, in corn, they're looking for basically record crop in corn. All the farmers I talked to are saying the exact opposite. So do we listen to the government's number pushers or do we listen to the farmers? And the reality is probably somewhere in between, because the government, they have their own thing going on. And sometimes I'm not trying to say that there's an agenda with the USDA, but maybe there is, maybe there's not. Some people say that, but the reality is they're probably very smart people, but sometimes smart people can be too smart. They're not street smart, they're book smart, and it's different. Trust me, it's different. So they're looking at one set of data or information. Farmers are looking at another, and they're coming up with two completely different numbers. And the only thing that's gonna, we won't know until we know. So all we can do is let time pass and see how it goes. But I've kind of over the years, I've kind of realized that USDA probably is usually a little too optimistic. Farmers are too pessimistic. Reality's in the middle. So
we went over the dangers for brokers and how traders are blaming everybody, and then you just brought up the whole thing with the USDA, and a lot of people believe that they have their own agenda. What I discovered is that in my trading, that when I hear the news, I can just use it as a catalyst to bring me to the price. Let the price speak everything after that. And that's why I asked you about your fundamentals versus technicals, because all the fundamentals in the world, they can lead us to believe something, lock into something, and have an unusually strong bias to the point where we will ignore everything that's right in front of us and hold ourselves into the worst situation ever. I've seen tons of traders, they kill themselves, they destroy their accounts by locking into whatever the news is saying. It shouldn't surprise me, but it surprised me how detailed and amazing your books are with technicals as well. I absolutely loved. I mean, you're going over the unique facets of them, but then how they can be applied as well. And I think that what you said was that you lean a little more towards technicals. Is that correct?
Yeah, I would say we're a brokerage, so we put out analysis and ideas to our clients, even trading recommendations, and they're generally based on technical analysis, but we don't ignore everything else, and we're actually paying attention to fundamentals, of course, but we're also looking at seasonality. Commodities generally have a very distinct seasonal pattern. Their annual highs and their annual lows are usually around the same time of year, not always, and especially in years like what we've had the last couple of years, things go awry. But they're patterns that everybody should be aware of. And we also look at the COT report, which is the Commitment of Traders report. It basically tells us who's long and who's short in regards to speculators. So large speculators and small speculators, where they're positioned and how much. And then it tells us where commercial hedgers are. Some people believe that some people focus on commercial hedgers and they think they can get some information out of that, and that's great. I personally use it for looking for overbought and oversold or overcrowded trades, I guess is what I'm trying to say. So, like for example, if large speculators are holding a really large net short position, we saw this in the S&P a few weeks ago, and we put out a newsletter. We actually even talked about it on Jim Cramer's Mad Money and a couple other outlets. Basically, there was nothing but bearish news coming out. I mean, no reason to be positive at all regarding the economy or the stock market. But the reality was, according to the COT report anyway, which by the way is put out by the CFTC, it's a government agency, basically everyone that was already short. So we were sitting on record net piles of cash, according to many of the investment banks on the stock side of things. And then in futures, we had speculators more short than they had ever been before. So we kind of just were at this point where even if the bearish news keeps coming out, who's left to sell? All the sellers had already acted, all the portfolio liquidation had already occurred. And so we started to get like a vacuum to suck prices higher, not because fundamentals changed or there's good news all of a sudden, but just simply because everyone was short and now they had to take profits or get squeezed out or get stopped out, and it's kind of feeding on itself. So it's going to be interesting to see what happens in the next couple weeks.
This is why I love listening to everything that you say. Sure, you can look at just price or technicals, you can listen to the news, but you're actually diving in, and I don't even know how you've gathered all this, but you know the inner workings behind the scenes. What does this and how this affects this? And
well, I mean, I've been doing this for a long time, and I've seen a lot of things, and I've learned a lot of really tough lessons. But I've also, even as recently as this year, sometimes all the great analysis in the world or what we thought was great analysis doesn't work out as planned. So there's always going to be flies in the ointment, like Russia invading Ukraine. Even though we thought we had kind of prepared for that, the slight chance of that happening, we didn't expect the markets to react the way they did, at least not in that amount of volatility. I mean, honestly, on the commodity side of things, I don't know what stocks was like, but everything was just broken. The option markets dried up, the liquidity wasn't there, the volatility was so ridiculous. You couldn't hedge any positions, and if you got out, you were just locking in massive losses. So I mean, it was really, really messy. So while I appreciate your words, I also must disclose that sometimes things just don't go as planned. And this year, the last couple of years actually have kind of been like that. It's just been a really rocky ride in commodities, and everyone assumes commodities have been going, we had these really big bull markets in commodities the last couple of years. But if you look at a chart, it's not been a smooth ride. So my guess is most people didn't enjoy it as much as you would think they would. If you look at crude oil, even the run from $90 to $130, if you look at it, it was mostly big switchbacks of $10 to $12 in between. And so you would have had to have either had impeccable timing getting in and out, or simply just been willing to accept 10, 20, $30,000 drawdowns on one contract to get to where you're going. So it's been really wild couple of years in commodities.
Yeah, that brings me to another point, stop losses. There's a lot of conspiracy theories with that too. Put your stop price in with stocks at least, and then all of a sudden the market goes straight to it like a magnet, stops you out and comes right back up, almost like somebody's reading your mind. So this is not the reason why I do this or did this, but I just one day started to mess around with, instead of me stopping out, I put an equal weighted hedge on at the point that I would have stopped out. That way I'm not losing any more money, but I still can work the positions. And then I found after that a lot of times I can end up profiting on my hedge, both my hedge and my core position. And this is trading intraday though. This is not trading like over long terms, because if you're long term, I'm guessing that's not going to be so easy to profit in both directions. But it was just this fun moment that you can now work with price a little bit differently when you're just not stopping right out.
Yeah, I agree with you. I know most people feel like the market's gunning for their stops. I can honestly say that's probably not the case. Most people that assume that to be the case are trading one lots in futures. And I can tell you with absolute certainty, no market maker or no market participant is gunning for a one lot stop. It's just not how it works. But I agree 100%. It always feels like the market hits stops or hits your stop or whoever's trading and then goes the other way. So that happens more often than it feels like it statistically should be possible, but it just happens over and over. So I am also a big fan of using options to hedge as opposed to stopping yourself out. Put some sort of option hedge on. Maybe if you're long futures, that might mean selling a call right away when you get in, or it might mean selling a call and buying a put or doing something like that. Or if you're trading in a very short time frame, you could use weekly options, or there's options in the futures that expire every Friday, or in some markets every Monday, Wednesday, Friday, and actually in the S&P it's every day. And so you can use those options to, just like you said, instead of placing a stop order, if you go long a future, just buy a put. It's going to cost you a little money. You're going to have some premium burn, but you don't have to worry about getting knocked out of the trade prematurely. So if it comes down and runs other people's stops and then goes back up, you're still in the game. And so I'm a big fan of that as well.
Have you done, I mean, I'm guessing you have, where you've profited both on your hedge and your core position then?
Sure. Oh, sure. That can happen. I mean, it can also happen the other way around, because when you
Or
do
you're
buy
losing them
options,
both?
right? When you do buy options, it's a premium burn, especially if you're doing short-term options. You're buying an option that expires at the end of the day or tomorrow. If the market trades sideways, let's say you put the option on the option hedge, you're still long the future, you buy the put, and the market trades sideways, it's very possible you end up losing on both. So it can happen that way. But I agree with you. It is entirely possible that you can make money on both, depending on how savvy you are.
I love every bit of this, and I can't wait to dive into futures more myself. The tax side of that, I believe, is pretty awesome compared to stocks as well, right?
Yeah, so if you're trading futures and you're actually making money, you're absolutely right. The tax situation's a lot better. So for starters, you don't have to list every transaction. When you file your taxes at the end of the year, you only list one number. It's how much you made or lost, and that's it. And you're done. You don't have to list each trade. Also, it's taxed at the 60/40 blend between long-term and short-term. So you're not paying all short-term capital gains tax. You're paying some long-term, some short-term. So it's a lower rate as well.
Futures with taxes can be beneficial. I do love how you don't have to turn this whole list in. It's just, I guess it's more like a win-loss, like a casino, it seems.
Yeah, I can't imagine listing every single trade. That just sounds like a nightmare. But I mean, the accountants probably love it, right? That's probably where they make all their money. They charge per hour and let it go.
So that brings me to another point then. Do you more or less just use the options in futures for a hedge, or do you think somebody could use that as their core trading strategy?
So we've done quite a few webinars and classes on the idea of using options as day trades. So for example, if you think the market's going to go up, instead of going long a futures contract and placing a stop, or going long a futures and buying a put, you could maybe just buy a call option out of the money, maybe even at a strike price around your price target. So you're not going to make or lose as much money as quickly with that type of a situation, but it's a lot less stressful. And if you do happen to get a runner, it's a little easier to hold on. So some people just prefer to buy calls or buy puts instead of buying futures and selling futures to express their opinion. And as far as the ideas that we provide to our brokerage clients, they're generally more position trades, not short-term trades. We're usually doing option spreads and things like that. So we usually have an option that we consider the money maker, or at least we hope it to be the money maker. And that's usually a long option. So if we think the market's going up, we're usually buying a call. And then we will usually sell options around it to pay for it. So that might mean selling two calls above, or might mean selling one call above and one put below. Just depends on what the situation is. And I think that's a good way to get in for those that don't have the personality for futures, that fluctuate pretty quickly, and it can become stressful for some people. Options is a good way to kind of pull some of the volatility out of it. It's not perfect, because sometimes options can get in your way if you're right. Like if you're really, really right, you might be sad that you didn't just go long a futures and make a ton of money, because you're going to make less with some sort of an option spread. But when things go wrong, it's a little easier to handle as well. So there's give and take with any strategy.
What I'm all about is consistency. I don't really care about swinging for the fences at all in my trading. I just want to lock in consistency. And then, futures, the leverage is a little bit more intense, or it can be. So people are lured in maybe so they can get this bigger leverage, right?
Yeah, and leverage is something that is available to anyone regardless account size in futures. If you're trading stocks, you need probably 50,000 to 100,000 an account to even let have your brokerage consider giving you leverage. In commodities, anybody gets it. Whether you're trading 2,000 or 2 million or 10 million, you get the same leverage. Um, it can be good, but it's probably mostly bad because the problem is humans don't know how to handle leverage, or they underestimate it, or they simply focus on what leverage can do for them on the positive side, but then discount what it can do for them if something goes wrong. And so leverage is something you need to really be careful with. We encourage our brokerage clients to only use like 25% of their account balance towards margin. This way that they're still using leverage, but they're not maxing out their leverage to a point where they have no room for error. Because the less leverage you use, the more room for error you have, and you're probably going to make better trading decisions because you're probably going to be mentally in a better place as well.
My idea is for coming over to futures, especially if
Mhm.
I'm brand new and I'm just starting, like I haven't even done what I've done, I would want to delev, I wouldn't want to
Yeah.
push the pedal. I would want to push the brakes and sort of put a limit to
Right.
it. It's like if I'm trading common shares, I could start with one share at a time. That way I can manage what's happening. And then when I work my way up to, okay, I'm comfortable with this strategy, it's working for me, then I can start adding a little bit to it. You just mentioned a little bit with your option strategy. That would be a great way to reduce that risk. Do you have any other ways that you
Yeah.
would say for
Yep.
starters?
So those are good points, and you're smart. You have the right idea. So the thing about futures is they're leveraged, but you don't have to use the leverage. You can remove leverage completely by overfunding your account or trading less. So, for example, if there are micro contracts in the stock indices, currencies, gold, and crude oil. And with these micro contracts, you basically can get everything that a futures contract offers. So 24-hour market, 23-hour market trading, liquidity, tax benefits, and all those sorts of things. But it's just a very small contract. In gold, we'll just use gold. Gold's trading around $1,800 an ounce. So one micro contract is worth 18,000. So if you put 18 or $20,000 in an account and you bought one micro gold, you completely eliminated all the leverage. So if the only way you could lose that $18,000 in your account is if gold went all the way to zero. Maybe it happens. I doubt it, but you can see that there's no leverage. If gold doubles in value, you double your account. I don't see that happening either, but just trying to give you an idea of how the leverage would work.
I started trading Netflix and Amazon and stuff and doing really bad at it. I stopped out right before we had the greatest bull run ever. Before that, I had done Forex paper trading, and then I started with these stocks because I wanted to buy everything. I wanted to buy
Mhm.
Coke, every brand I knew, everything I had to buy at
Yeah.
least once and sell it once, mostly losing on all that. Then I went to penny stocks. I got some unusually good momentum. It worked out for me accidentally. And then I got to the point where I was like, this is impossible. Nobody's really doing this. I don't know how anybody succeeds in this. Everybody here's saying that they're making money when they're not or something,
Yeah.
If somebody wanted to start with, because I have a lot of people that come to us that they have small accounts, is there a way to trade and start in futures with small accounts?
Absolutely. So, for example, our brokerage has a minimum account size of 2,000. So you can open with as little as 2,000. And if somebody that decides to do that, I would say trade the micros. So let's say the micro euro, the margin the last I checked was like $300. So 250 to $300. The margin on a micro crude oil is about 900 to 1,000. Micro gold is like 800. So with a $2,000 account, you are using leverage, but you are also giving yourself enough room for error that hopefully you can run your strategy. It's kind of like paper trading with a little skin in the game. So at least you get a little taste of the emotions without, you're probably not going to ruin your life trading the micros, probably not going to get rich either, but it's just a really good way to kind of test your strategy, see if it's working, see if you like it, and see if you want to do something on a bigger scale.
Typical like S&P futures micro contract. What does
Mhm.
that look like?
So so the regular S&P futures contract is $50 a point, and it's roughly, I'm going to round, but it's roughly about $200,000 worth of stock. It's a little less than that now that the market's down, but you get the idea. A micro contract is 1/10 the size. So for every point the S&P goes up or down, you're only making or losing $5. And the contract size is roughly 20,000. So again, you could trade the micro S&P futures in a $20,000 account and have zero leverage. If you did it in a $2,000 account, you would have quite a bit of leverage, but you still have a good amount of room for error. Um, the margin, I think the last I checked was about $1,100. So you'd be able to comfortably hold overnight and and trade as you needed, as you wanted to in the micro with a $2,000 account.
So probably not what somebody would want to start with then. For somebody
Yeah,
that has a smaller account that's trading penny stocks that only wants to have that
sure.
$2,000-$3,000 account.
Yeah, the S&P of 2019, absolutely. The S&P of 2020 and 2022, no. I would say the most conservative way to practice trading futures in a $2,000 account would be to use like probably microcurrencies is going to be the slowest mover. It's a lot like if anyone that's ever traded forex, it's the same as micro forex. They're really tiny, small contracts. I think they represent about $10,000 worth of currency. They don't move a whole lot, so that's a good place to start with if you have a really small account.
So you got these futures contracts. It's based on month, correct?
Mm-hmm.
And then
Correct.
you have options based on that month's contracts as well. So a derivative of that.
Yep.
Would you say that futures options, this might be going back a little bit, but are more dangerous than just trading options in the equities world?
I would say yes, because options on futures are written against a leveraged product. So options in general are leveraged just by nature. And so if you're talking about options written on a leveraged product, then it just enhances the leverage, which is great if you're on the right side, not so great if you're on the wrong side. I do think that options on futures tend to be more expensive because they're leveraged and because you're really dealing with more money. So can work for you or against you, which is one reason why I prefer the idea of people using option spreads so that instead of paying a fortune for an option, because options are priced to lose. Most options expire worthless if you hold the expiration. I would venture to say most people don't hold the to expiration and probably shouldn't, but if you did, you're probably going to lose more than you don't if you're an option buyer. But as a spread trader, you're kind of taking advantage of both sides of the coin. You're collecting premium, so you get some time value erosion to edge what you're losing on the option you buy. So in my opinion, that's probably the most optimal way to do it. Again, it's not perfect because when volatility, if you're option spread trading in a moderate volatility environment and suddenly something unexpected happens and volatility spikes like we've seen in the last couple of years, you'll find that there's trades like, for example, vertical call spreads where you buy a call and sell a call further out of the money. Something like that should do very well if the market spikes up, but if the volatility is abnormal, vertical like we experienced in crude oil, we had some vertical call spreads that literally did not make money, even though it was they were wildly in the money. The profit and loss was non-existent just because the volatility exploded so much. So weird things can happen with options, and it can be frustrating. But I try to point out to traders that what we've seen the last couple of years is kind of the exception, not the rule, or at least I hope so. I've been doing this for a long time. I've never really seen anything quite as weird as what we've seen the last few years. And I doubt it's going to last. The sad thing is when you see this kind of volatility, it lures a lot of traders into the markets, but it's probably also going to burn a lot of traders. And so they'll shuffle right back out. And when that happens, the volatility will die and things will normalize. And I suspect by next year, we'll probably see something to that effect.
Your first book was on options, correct? Option strategies?
My very first book, yes, and I think it was released in 2009. I've since rewritten that book. It's much bigger and better now, but yes, the very first one was called Commodity Options.
So if I wanted to go and learn your option strategies now, where's the best place that you would direct me?
So if you wanted to learn more about options, my latest book is it's called Trading Commodity Options with Creativity, and if you did happen to read the first book from 2009, most of you probably have not. But if you did, it's basically that book, but rewritten bigger and better. So it's the same general idea. We cover several option strategies. We offer a lot of examples, like when things go right, when things go wrong, and what to do in each situation.
So you definitely didn't put me to sleep. You helped me more or less because This day was incredibly exhausting, and then I love the info. I really want to learn more, and I know that a lot of people in the community want to learn more as well. I started this thinking that you had to come spend a lot of money for some courses, or get into somebody's live stream and spend quite a bit of money for that too. And since I've seen so many amazing things like your books, Brian Shannon's books, like just there's so much information out there that tells you all the things you're looking for and that you're probably not going to find in these. Recently, I started getting into the Series 57, Series 7, Series 3 study guides and stuff like that. And it just blows my mind because it's like, why did I waste so much time going this way when I could have just had what's right here already for me,
I understand. One thing I'm just going to mention, you mentioned the courses. Now, there's some really, really good courses out there, but you really have to be careful. The majority of courses, especially if they're charging a very large amount of money to participate, um, I'm not saying they're bad, but you have to really question whether or not it's worth spending that kind of money, because if somebody really had some sort of special system or magic sauce that enabled them to easily make money in the markets, they're probably not going to sell it to everybody. It's easier and it's less work to just trade the markets if you have some special thing going than to try to sell it to people. So, not saying they're all bad. I'm just saying buyer beware. Make sure you do your due diligence before you pay a whole bunch of money to go to a course.
What I've learned with that is a little way off topic, but I heard so many people say that for a course, why do you charge so much if you're making so much in the market? And it's like, well, now I see that a lot of these people would be charging just to have a barrier to entry, to keep out you don't want just everybody sometimes coming in and ruining it for all the people that really mean it and they want to be there and they want to learn.
Yeah, no, that's an excellent point. I'm glad that you brought that up because, like I said, there are some really, really great courses out there and good coaches. I'm not saying everyone's like that. I'm just saying there's both sides, and so the weeding out some of the people looking for freebies is actually a very good reason to charge a lot of money for a course.
So you have your books. I've seen you have a lot of videos out. Do you have courses as well?
So we don't really do courses. We are, as a brokerage, we're regulated by the CFTC and the NFA, and the rules and the red tape are really thick. So we have to be real careful what we put out there. And we've just been so busy and have our hands full with what we've got going on. We just hasn't been on the radar to do some sort of a course. Maybe in the future, but at this time, probably not in the foreseeable future. Let's put it that way.
Well, that's super awesome, though. I'm really glad that you decided to come on here and give up part of your Saturday to be with us. I really appreciate it, and I'm gonna get more into your options book. I've enjoyed everything so far, and like I said, every single, even the basics, even the elementary stuff, as I think that's how you put it. You put that extra bit in there that I don't know, just it may be something that's like that aha moment for people that,
Thank you.
wow, I can use that this way.
I hope so. Well, what I tried to do is there's a lot of really good books out there that make a lot of assumptions. They assume that people already know certain things and have this base knowledge, but the reality is not everybody has that. And so I tried to be very, very thorough and make sure if I'm going to talk about this, I talked about everything that needs to be known before you get to that point. So thank you. I appreciate your feedback.
Yeah, in particular, I would like just you going over Bollinger Bands and what Bollinger Bands, how standard deviation, and overbought, oversold, and just where it sits standard, like within 2 to 3, and it doesn't stay outside of this long, and then how you can apply that to looking for a trade in this direction or that direction.
Right.
That alone is what I've seen some people would package as a strategy and try to sell it for, pricey course. But anyways,
well, thank you.
Thank you so much, Carley. I really appreciate you coming on with us.
No problem. Thank you. It was fun. I enjoyed it.
Yep, have a great day. Thank you.
Thank you.
Yeah.
Ordered Phil, check us out.
I know what time it is.
This is the Mighty Soldiers exclusive.
Yeah. Let's get it. Let's get it.
If
you wanna take it to the streets, let's get it. If you wanna take it to the booth, let's get it. I'm about to take it to the top, let's get it. We ain't never ever gonna stop, let's get it. You ain't never heard nobody spit like this. Call the paramedics when I get like this. Front page news when I wreck like this. Hop in the booth and I wreck that shit like,
If you with the squad, then you already know what's up. It be going down, but my account is going up. I'm about to make another 100,000 bucks. Rolling up that chain, I'm about to take another puff.
Hold up, I made a killing, now my pockets got swollen. Independent, now I'm taking over. I'm a lot richer, you a lot broker. I'm a pot smoker, stockbroker, blowing up like a supernova. On my mama, I was born a soldier, the best in the game, man. I thought I told you. If you wanna take it to the streets, let's get it. If you wanna take it to the booth, let's get it. I'm about to take it to the top, let's get it. We ain't never ever gonna stop, let's get it. You ain't never heard nobody spit like this. Call the paramedics when I get like this. Front page news when I wreck like this. Hop in the booth and I wreck that shit like, I am unstoppable, I can do anything I ever wanted to. Never did anything they ever wanted me to. Got on my side and I'm not gonna lose and they're not gonna win. I see them, the haters, it's salty cause I'm getting dollars again. Commas on commas on commas, I'm buying the dip. The market is dropping again. I can see him hating from the sidelines. If you see a hater, tell him bye-bye. Watch my money grow, 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 grow. And my wifey like, whoa, 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 whoa. Whoa, somebody better stop me cause there ain't no competition and I'm coming for the top position. Obliterating the opposition every time that I jot it in the composition. Everybody wanna stop and listen cause I bring it to you hotter than the oven in your mama kitchen. I'll be getting here like a politician. I'ma get bread when you stack looking taller than Scottie Pippen. Ain't nobody ready for the Armageddon when I pop the clip and I ain't playing. I'm spraying you brain, I'm bringing the pain like Damon Wayne. You disappear like David Blaine. I'm dropping bombs, Saddam Hussein. Stop and aim, pop you lames and pop champagne. I ain't playing so stop the games, you know the name. If you wanna take it to the streets, let's get it. If you wanna take it to the booth, let's get it. I'm about to take it to the top, let's get it. We ain't never ever gonna stop, let's get it. You ain't never heard nobody spit like this. Call the paramedics when I get like this. Front page news when I wreck like this. Hop in the booth and I wreck that shit like, yeah. Yeah, yeah. Alright, man, I'm out.